Sanford Coggins, CEO and founder of VisionWise Capital, a real estate fund manager located right down the street in Mission Viejo here in Southern California. And he's with us here in the studio. Sanford, welcome to Strategic Investor Radio.
Charlie, thank you so much. It's great to be back.
So, Sanford, you started out after being raised in Southern California, started out University of Texas, began as a quarterback, and then switched to wide receiver. You guys actually played in the national championship in one of your years there. Then you spent decades as a wealth manager and then transitioned to commercial real estate development. Now, that's not a typical path of anybody. We're going to ask you why and how you did that. But before that, Sanford, you've played at a level of sports that few have in front of 100,000 people, many times, and millions watching on television. What are some insights you could share with us, or some things that over the years, it's been a few years now, some insights of things you gained by having done that?
Charlie, I'd love to be able to consolidate this into some one-sentence scenario, but there was so much. I mean, moving 1,400 miles away from home and having to reestablish yourself and figure out who you are when everyone you know who told you who you were isn't around. That in and of itself grows a person in a hurry. But walking through the tunnel, I mean, coming in to the stadium with 80 to 100,000 people, stands shouting and screaming, that's an experience. It's an unbelievable rush. Signing footballs when you know within yourself that you're not all that, but people think you're something else, that's huge. But I got to play with some guys that were absolute superstars on the field. I mean, Johnny Lamb Jones ran a 4.240 gold medalist in high school at the Olympics in '76, and Earl Campbell got to hand the ball off to him my freshman year. And so there was a number of things. I think the biggest of it was my straw got widened. And what I mean by that is I think we all look at life through a straw. Some straws are wider than others, but nobody sees it all. So my straw got much wider by having made that journey to Texas.
Well, that's great to hear, and we appreciate you sharing that with us, and glad you've been able to learn from it and grow and contribute here.
Yeah,
so.
Yeah, there's no question. It's what you do with your time, as in traveling and reading books and the people that you hang out with. I don't know of anything that actually grows a person any greater than that.
I bet. So tell us about your transition from the world of wealth management to the world of commercial real estate development, which is a very different world, and very few take that path.
Sure. Well, out of college, I went to commercial banking, and I realized I didn't want to be a banker, but what I learned there in terms of credit analysis was very helpful. I came back to California and was actually in the commercial real estate brokerage business for about 6 years. And from there, got an opportunity from a friend of mine right about the time the real estate market slowed to go to work with Merrill Lynch. And that was an amazing experience on the wealth management as well as the investment banking side of things. But to blend them together, I never let go of real estate. I continue to do real estate syndications. I continue to buy as a principal. So when it came down to the 2007, 2008 time horizon, we were able to pull clients out of the stock market in literally February through March of 2008. We missed the downturn altogether. It was very fortunate. We moved money into cash. We had real estate paying income at the time. And we missed it. So what I learned is that, one, I'm not really a big stock and bond guy. I mean, I really didn't know how to pull the levers to really make that product work for my investors. But real estate always seemed to work. So I started VisionWise Capital in 2013, and that's where we've been since then. I couldn't be happier with the product that we're using, and as well as the tools and the strategy that we have.
So tell us about your strategy and basically what differentiates you guys from competitors here?
Sure. In the early goings, I was buying real estate in general. And then I realized as an operator, you really need to narrow your niche. And that's what we did. We sold a couple hundred units in Sacramento, for example. And in a 3-week period, we had 11 offers. And I went to the 5 best and final letters that went out, and each one of those potential buyers had over $30 million of cash in the bank. So what I realized is I'm not going to be able to rightfully compete in that space. They overpaid, in my opinion, for the building that I was selling. Investors did really well, but I decided to narrow the niche to 5 to 50 unit apartment buildings, and that's what we do. In that space, there's over 3,200 of those properties in Orange County alone. And what I can do with our institutional knowledge is sort of dominate that marketplace, which is what we are doing right now. We're just coming in with an institutional mindset, being able to crank out these units and turn them quickly, and at the same time respect the tenants in the process, so we're able to contain, or I should say retain, up to 50% of the tenants in every building that we turn.
So what do you see as the key elements of success in that particular narrow niche?
Yeah, that's great. We're dealing with smaller zeros. So the team before Christmas, we were talking about what we do, and I pulled a Ray Kroc story, right, when he said, "What business am I in?" And he was the founder of McDonald's. But here he is talking to this MBA class, and some person stood up, and they were confident in themselves enough to say that he was in the hamburger business, and you knew it was a set-up question. And he answered, "No, I'm in the real estate business." And at the time, he was the largest private owner of real estate in the country with all those commercial locations. And we're in the same business. We're in the real estate business as a product, but we're actually in the manufacturing business in terms of our methods. We are in and out of a unit in 3 weeks and a day. We clock everything. Everything's measured to time and cost. We have incentives at our general contractor level based on how quickly we're in and out and how well it's done, and how quickly we release the unit.
So you say in and out. You're talking about upgrades.
Upgrades, absolutely. Okay. I mean, the upgrades that we do, again, soft close cabinets and drawers, new flooring, new appliances, everything's new in that unit.
Basically cosmetic improvements.
Cosmetic indeed. But for the tenant, it's like moving back into $1 million home.
Really?
It really is. I mean, you can look at our website and you can see some of the accoutrements that we add, and it's pretty spectacular.
Okay, and so you go in looking for what?
We're looking for buildings that are old, tired, dusty, and fully occupied. That's ideal.
Come to my house.
Yeah. What we found is the demographics that own 5 to 50 unit apartment buildings in Orange County, and I think throughout major MSAs in the country, I think that the early baby boomers in their late 60s and the silent generation mid-70s, that's who owns them. And invariably, they enjoy mailbox income from those properties. What they don't want is to have to go back in and property manage them. They don't want tenants and issues and toilets and that sort of thing. What we do is we come in at a time where the leases have rolled over to month leases oftentimes. So we're buying a property that's fully occupied, but the rents are significantly below market. Not for that product, but by the time we finish, we're able to move rents as much as 25 to 35% upwards. Here's the key. In those buildings, again, nearly 50% of the residents stay and pay the higher rent because we're not charging more than everyone else. We're just charging equal to what other buildings are charging that have our type of upgrades. The only difference being that they were done 5 to 10 years ago. Ours is brand new. So for the new car smell, we get the first tenants, but they're paying a much, much more aggressive rent.
Now, in a world where for decades, people have been raising money, going out and buying properties, multifamily housing has been very popular over the past couple decades.
Yeah.
Okay, and living in Irvine,
yeah,
and you're not far away. Multifamily, high-density housing is the rage and has been, and just drive on the roads and you discover that. Okay,
yeah, that's right.
How is it that this is still an available niche?
One thing that I've learned is that real estate has multiple products within it, and I think people don't recognize that as often. They consider single-family residences and office buildings and retail centers. They categorize it as real estate in general. When you come to apartments or multifamily, the same is true. There's a strata. And the product that's being built today, that high-rise sort of village apartments in Orange County, for example, that has a market downstairs and a deli and a dry cleaners and across the street from entertainment, that's set up for the millennial generation effectively to be able to live, drive, Uber actually, and do everything close at hand. That's not the product that we buy. We buy things in the 1960s to 1990s construction. They're not building that anymore. It's a mile from the ocean. So when a recession hits, which will happen eventually, the two millennials that are occupying that 2-bedroom unit in that high-rise apartment building, one of them loses a job, and the other one either moves home or they move into our product, which is a lower cost, but the accoutrements are just as pleasant. So we find that we're a little resistant to having that product come online. In fact, it helps us because it pushes rents for everyone.
Well, very, very interesting. So how is it that you protect the investor?
The critical thing for me is, I say it this way, I do not want any D's or F's on my report card. I don't mind a C. I'll get my A's and my B's, but at the end of the day, do not lose principal. That's key. So the only way that I know to really minimize the risk of losing principal in real estate is to reduce the leverage. In fact, I'd say that 85% of the risk of real estate is the leverage. It's not the real estate, because the real estate rebounds over time, like we've always seen it do. But if you want to lose something, lose it to the bank and it's gone forever. So the reality of it is our loan-to-cost maximum is 50%. And the reason for that is when I ran the algorithms early on, I found that at an 80% loan-to-value, if the net operating income of an apartment building dropped by 12%, you run the risk of losing the asset to the bank. You get a notice of default. Whereas with a 50% loan-to-value, it takes about a 32% drop in net operating income. Now, in the 2008-2009 recession, the average NOI in Orange County dropped about 20%. So I'm suggesting that it would have to be something worse than the Great Recession to occur in Orange County or in this country for us to be at risk of getting a notice of default from the bank. We will ride through a recession.